The IRS just changed everything for seniors this year. Not slightly, not in a way that only affects a few people in unusual situations. In a way that affects every American over 65 who filed taxes this year or is about to file. A law signed on July 4th of last year introduced the biggest tax changes for seniors in decades. And the seniors who are making the biggest mistake right now are the ones who filed their return the same way they always have, without knowing that a new rule exists that could have reduced or even eliminated their federal income tax bill entirely. The mistake is not complicated. It is a single form, with a single number on it, that most seniors never added to their return because nobody told them it was there. Two neighbours, same age, both retired, both filed their taxes this year. One neighbour added one form to her return, 20 minutes of extra work. Her federal income tax bill dropped by thousands of dollars. She received a larger refund than she has ever received in her retirement. She's using it to pay off a medical bill she has been carrying for 2 years. The other neighbour filed the same way she has filed for the past 12 years. Same software, same process, same result. She paid full taxes on her retirement income. She did not know the new form existed. She did not know the IRS confirmed this deduction in official guidance published in February 2026. She left thousands of dollars on the table and handed it to the IRS instead. The IRS does not call you to tell you about deductions you missed. It does not send a letter saying you overpaid. It keeps what you send. And what most seniors sent this year was more than they legally owed. Here is exactly what changed and exactly what the big mistake is. The One Big Beautiful Bill was signed into law on July 4th, 2025. The IRS confirmed its provisions in official guidance published on January 9th, 2026. For seniors, the most significant change is this. For tax years, 2025 through 2028 taxpayers who are age 65 or older may be eligible to claim an additional $6,000 deduction per person. If you are married filing jointly and both spouses are 65 or older, the deduction is $12,000. This is a new deduction. It is separate from the standard deduction you already take. It is separate from the existing additional standard deduction for seniors under existing law. It is an additional $6,000 on top of everything you are already claiming. The IRS confirmed this applies regardless of whether you itemize or take the standard deduction. Both groups qualify. You do not have to choose between the existing deduction and the new one. You claim both. Seniors age 65 and older may be eligible to claim an additional $6,000 deduction. All new or enhanced deductions are available for both itemizing and non-itemizing taxpayers. But here is the mistake that is costing seniors thousands of dollars right now. The deduction does not appear automatically on your tax return. It requires a specific form. Taxpayers claiming these deductions should use Schedule 1A and see the related instructions. Schedule 1A, that is the form. If your tax software did not automatically prompt you to complete it, if your tax preparer did not mention it, if you filed without it, the deduction was not claimed. The IRS will not add it for you. The money you could have saved stayed on your return as taxable income. And it phases out. The eligibility phases out for taxpayers with modified adjusted gross income over $75,000 for single filers and $150,000 for joint filers. If your income is above those thresholds, the deduction reduces. If your income is significantly above those thresholds, it may not apply. But for the millions of seniors whose retirement income falls below those limits, this deduction is real, it is confirmed, and it is available right now. Subscribe to this channel right now before we go any further. Hit that bell. Like this video. Share it with every senior you know who filed taxes this year or is planning to file. Comment below and tell me yes or no. Did your tax preparer or software mention the new $6,000 senior deduction this year? Subscribe. Bell. Like. Share. Comment. All of it right now. Because what comes next is the complete list of 2026 IRS changes affecting seniors and exactly how to make sure none of them cost you money they were not supposed to. Here is everything else that changed for seniors in 2026 that is generating mistakes right now. The standard deduction increased. For 2026, the standard deduction for single filers is $15,750, up from $14,600. For married couples filing jointly, it is $31,500 up. from $29,200. For seniors 65 and older, the additional standard deduction is $2,000 for single filers and $1,600 per qualifying spouse for married couples. For taxpayers both 65 and older and blind, the amount doubles to $4,000 for an individual. These numbers changed. Seniors who used last year's numbers in their calculations filed on incorrect information. The IRA contribution limit increased. IRA limits increased to $7,500 for 2026, up from $7,000. If you are still contributing to an IRA and you used last year's limit, you may have room to contribute more before the deadline. Every additional dollar contributed to a traditional IRA reduces your taxable income dollar for dollar. The 401k contribution limit increased. The 401k limit increased to $24,500 for 2026. For seniors 50 and older, the catch-up contribution limit allows an additional $7,500, bringing the total to $32,000. But there is a new trap inside the catch-up contribution rule that is catching seniors off guard. The new Roth catch-up mandate means that high earners making $145,000 or more must direct their catch-up contributions to a Roth account rather than a traditional pre-tax account. Seniors who are still working and still contributing, who earn above that threshold and directed their catch-up contribution to a traditional account, may have an error in their filing that requires correction. Paper refund checks are being eliminated. The IRS is phasing out paper tax refund checks. Taxpayers should use direct deposit to receive tax refunds faster. Seniors who are expecting a refund check in the mail may be waiting for something that is not coming. If you do not have direct deposit set up with the IRS, your refund may be delayed significantly as the agency transitions away from paper checks. Log into your IRS account at irs.gov and confirm your direct deposit information is on file before your refund is processed. The new deduction expires in 2028. The bonus deduction is temporary. It will only be available from 2025 through 2028. That is 4 tax years. After 2028 it expires unless Congress renews it, which means the opportunity to claim $6,000 per person in additional deductions exists right now. This year, and for 3 more years. Missing any of those 4 years means leaving money that is legally yours on the table. So here is exactly what you do right now. If you have already filed your 2025 tax return and you did not claim the new $6,000 senior deduction, file an amended return using Form 1040-X. You have 3 years from the original filing date to amend. The process takes less than an hour with a tax preparer. The refund from adding a $6,000 deduction for a single senior in the 12% tax bracket is $720. For a married couple where both spouses qualify, the refund from the $12,000 deduction is $1,440, money that was legally yours that you can still recover. If you have not yet filed, add Schedule 1A to your return before you submit. Look for the senior deduction line specifically. Confirm with your tax preparer or your software that the $6,000 amount was applied. Do not assume it was included automatically. And if your income is close to the $75,000 or $150,000 phase-out thresholds, speak with a tax professional about whether any deductions you already take could reduce your modified adjusted gross income below the threshold and restore eligibility for the full $6,000. The neighbour who added that one form is using her larger refund to pay off a medical bill. The neighbour who did not add it is still carrying that same bill. The form exists. The deduction is real. The IRS confirmed it in February 2026. The only question is whether you claim it before the opportunity passes or after it already has. File the form. Claim the deduction. Keep the money that was always supposed to be yours